Good evening and welcome to our IHMVCU Financial Fitness webinar. I'm Katie and we are excited to have you join us to learn about how to build credit. Whether you're just starting your credit journey or aiming to improve your financial habits, our financial coach will provide practical tips and strategies to help you take control of your finances and build a stronger financial foundation. In this webinar, we will cover understanding credit reports and scores, learn what a credit report is, what a credit score means, and how they impact your financial health, factors affecting your credit score, discover what influences your credit score and how to make positive changes, strengthening your credit score, explore actionable steps to build and improve your credit over time. I'd like to introduce our knowledgeable IHMVCU speaker tonight, Kelsey Rotz. She is the financial coach at our Moline Avenue of the Cities location. Kelsey has been with IH for a combined total of 7 years and has been in the financial industry for about 10 years now. She has held a range of positions at the credit union from teller to assistant manager to financial coach. She is a certified credit union financial counselor, which has helped her guide many members on their financial journey to success. So welcome, Kelsey. Before we jump in, I wanted to remind you that everyone is muted for the entirety of this session. If questions arise during the session, please place them in the chat and we will address them at the end of the webinar. Also, this session is being recorded for future viewing purposes. Without further ado, I'll hand it over to Kelsey.
Hi, everyone. Like Katie mentioned, I am the financial coach at the Moline Avenue of the Cities location. So you may be asking, what does a financial coach do? Well, you can go to any branch and speak to a teller to do simple account transactions, open accounts, maybe even apply for a loan. Financial coaches can do all of that. However, we take it a couple of steps further. Most, if not all of us, are CCUFC certified, which means we are certified financial counselors. We have gone through the classes and the testing to help our members on a more in-depth personal level. We offer financial health checkups where we can complete several tasks depending on the needs of our members. For example, if your overall goal is to save more money, we can go through your income and expenses with you to establish a budget and see where you can improve, set up other accounts for saving, even help contact your bill payment companies to see if they can decrease your monthly payments. If your overall goal is to improve your credit, we can complete a soft credit pull of your report to see what we're looking at and give you recommendations based on what your report looks like, whether that be debt consolidation, paying off collections, creating a healthy mix of credit lines, etc. Please keep in mind that these financial health checkups do not often result in an immediate fix for everything. Improving your financial health is not an easy task. It takes a lot of time and effort to stay on track. So we as financial coaches are here to help guide you through that process. The main thing we ask of you is to be as dedicated to helping yourself as we are to helping you. So if you like what you hear today or want to see what we can do for you, please set up an appointment with one of us. We will give you instructions on how to do that at the end of the webinar. So let's get started talking about credit reports and scores. So what is a credit report? Short answer, a credit report is a detailed report of an individual's credit history prepared by a credit bureau. Long answer, the 3 credit bureaus are going to collect your financial information and create a report based on that information. So when you go to apply for a personal loan, a car loan, a credit card, etc., these lenders will use these reports along with other details to determine your creditworthiness. So who are these credit bureaus? They are Equifax, Experian, and TransUnion. It's important to know what credit bureau is being pulled when applying for a loan because not all lenders use the same one. IH, for instance, only pulls through TransUnion for our consumer loans. However, if you're applying for a mortgage with us, we're going to use all 3. A great question to ask before applying for anything would be if the lender is completing a soft pull or a hard pull of your report. So when applying for any loan, it's likely going to result in a hard pull. A hard pull or inquiry has the potential to drop your score if you make too many inquiries in a short amount of time. So we'll get more into that later. On the other hand, a soft pull means that they could pull your report without affecting your credit score. This may also mean that the number that you're going to get with a soft pull may not be 100% accurate, but I have seen results be fairly close in the past. When you open an account at IH, we will complete a soft pull of your report. However, if you apply for a loan with us, this would be a hard pull. Some other examples of a soft pull would be some of the apps you may hear about, like Credit Karma or CreditWise, if you have like a Capital One credit card out there. You can view your score as many times as you would like, and it won't affect you with that soft pull. It's also important to note that if you pull your credit with all three bureaus, whether that be a soft or a hard pull, the three scores that you're going to get are never going to be the same. And this can be for several reasons. Sometimes when you get a loan, that lender may not report your on-time payments to all three bureaus, maybe just one or two. This can cause discrepancies in the information available to each agency. Another reason could be that the lender may update information with each bureau at different times of the month, leading to variations in the credit reports as well. So while the credit score is what most people focus on when looking at their report, it is far from the only thing that's on there. So what else is on a credit report? So that's going to have your personal information on there. So your name, your current and previous address, your date of birth, your social security number, your current and previous employers. It's going to have your credit history. So the number of accounts that you have open and closed, whether that be credit cards, mortgages, car loans, student loans, etc. Your payment history, so whether you've made your payments on time and if there were any late or delinquent payments. Collections will be listed, so any unpaid debts that have been sold to a debt collection agency. And your credit inquiries, so a list of each time your credit report was pulled in the last 2 years. And it will also have your public records, so court records that could affect your creditworthiness, such as bankruptcies, liens, court judgments, lawsuits, and unpaid child support. Now that we know what should be on your credit report, let's talk about what to do if you see something on there that shouldn't be. So errors can happen. So you should always make sure everything is accurate. You'll want to look for identity errors on your report. So is all of your personal information correct? We see it quite often where maybe a father and son have the same name, but maybe dad's social security number is listed incorrectly on the son's credit report. Check for your account status. So are your credit accounts correct? Do you have closed accounts showing as open or open accounts showing as closed? Are your accounts incorrectly reported as late or delinquent? Do you have the same debt listed more than once? Do you have accounts listed on your report that don't even belong to you? Are your balances correct? So this one, if they're off slightly, that's okay, because most lenders report your balances to the bureaus at the end of the month. So your most recent payment just might not be reflected yet. I'm talking more if maybe you put like a $10,000 principal only payment on your mortgage 3 months ago and that's still not showing. And lastly, do you have outdated information still listed? So while looking at all of this, if you do find an error, you're going to want to dispute that error with the credit bureau that has the incorrect information. So the first thing you'll want to do is gather as much evidence as possible to support your claim, whether that be payment receipts, payoff statements, etc. Next, you'll want to decide how you wish to dispute this error. So you can do this by mail, phone, or online. And online is probably the easiest way, and you can go to transunion.com, Experian.com, or Equifax.com to do so. If the error is, say, a loan payment that is showing as late, but you always have paid it on time, it would also be a good idea to contact that lender to make them aware that you're filing a dispute. Lastly, always try to monitor this dispute. So these bureaus are legally obligated to investigate your dispute once they receive it. So it's important to keep track of how it's going. You may be able to receive emails or go into your account online to check on updates. If you do find some sort of error on your report and are just feeling lost or maybe overwhelmed, please feel free to set up an appointment with a financial coach. We can help guide you through this process and maybe help ease your mind a little bit. Speaking of that legal obligation, there is something called the Fair Credit Reporting Act. This is a federal law that protects your personal information and credit reports. So I'm just going to go over a few things that are included in this. So the Fair Credit Reporting Act requires anyone who uses a credit report to deny credit or maybe offers less than favorable terms, they must say why they denied that credit. And then give you the contact information for the bureau they used. So IH calls this an adverse action letter. You have the right to know what is in each credit report and are entitled to get one free report from each of these 3 agencies every year. Like we just discussed, you have the right to dispute inaccurate information, but if for some reason you're having a problem and can't resolve this, you can seek help. There's a phone number that we can give you, or you can go to consumerfinance.gov. Access to your credit report is limited to people or businesses with a valid need to use it. So no one can pull your credit report basically without your authorization. Just like your employers, you have to give your consent in order for them to pull your credit. And those are just a few. So I would highly recommend looking this up in your downtime. It is so important to know your rights. So if you do have any questions on any of the topics we have gone over so far, please feel free to drop them in the chat and we can address them at the end of the webinar. Now let's get to the main reason why you're all here, your actual credit score. So what's a credit score? A credit score is a number ranging from 0 to 900 based on the information in your credit report. The number is basically a prediction and likelihood that you'll pay your bills and debts on time and as agreed. People with uncluttered credit reports are likely to have higher scores and present a lower risk to creditors than people with, say, messier reports and lower scores. A question I get a lot is, what's a good credit score? And that question's kind of tough to answer in general terms. I wish I could say get that 900. Unfortunately, that isn't very realistic. I can say that with IH, if you're looking for the best loan terms and the lowest interest rates, anything 730 and above will get you there. Now, other lenders and financial institutions may have different tiers for this. Some may say that anything over 700 is an A+ credit tier. Others may require a 750. It's important to ask these questions before allowing any lender to pull your credit. But the general rule of thumb is higher the score, the lower the interest rate. Now let's take a look at the box on the right side of your screen. This will show you how having a higher credit score can save you thousands. This chart is based off of a 5-year auto loan with a starting balance of $30,000. And for example, let's start this off by saying your score is 550. This is going to give you a 14.8% interest rate, a $711 monthly payment, and the total amount of interest you would pay back in those 5 years equals $12,660. So the total amount that you would pay back to the credit union after that loan's done, $42,660. Now let's compare that to say if you had a 750 score. This would give you a 3.5% interest rate, $543 monthly payment, and the total amount of interest you would pay back in those 5 years, $2,604. So the total amount you'd pay back to the credit union after the loan's done, $32,604. This is an overall savings of $10,056 over 5 years. And if you're like most Americans right now, living paycheck to paycheck, that's $168 extra in your pocket every month for groceries, childcare expenses, or maybe just a nice treat for yourself. All because you spent the time to learn about and build your credit score. Next, we're going to discuss how your credit score is actually determined. So what affects your score? 35% of your credit score is based off of payment history. So this is the most important factor. The first thing any lender wants to know is whether you've paid your past credit accounts on time. This helps them figure out the amount of risk they'll take on when approving a loan. The next highest factor is amounts owed. So this makes up 30% of your score. Now, having credit accounts and owing money on them does not necessarily mean you're at like a high risk borrower with a low credit score. However, if you're using a lot of your available credit, this may indicate that you're overextended, and lenders can interpret this to mean that you are at a higher risk of defaulting. Factor 3 is length of credit history, and this makes up 15%. So basically, how long have you been using credit? If you're just starting out, even though you both have 100% on-time payments, your score might be much lower than someone who has been building their score for the past 15 years. 10% is based on a healthy credit mix. So this means having different types of loans. So a credit card, an auto loan, personal, mortgage, etc. It's not 100% necessary to have one of each, but it could help you. And the last 10% is based on new credit. So research shows that opening several credit accounts in a short amount of time represents a greater risk, especially for people who don't have a long credit history. So if you can avoid it, try not to open too many accounts too rapidly. Having a lot of different lenders pull your credit in a short amount of time can also affect your score, even if the loan is denied. So regardless of the outcome of the application. I get this question all the time. What if I don't have credit? Having no credit at all can be just as frustrating as having poor credit. However, if you've never had a loan before and you're just starting out, you have no negative information on your report that you have to take care of or pay back. So you're kind of starting from scratch and can possibly build your score even faster. In most cases, you have to be 18 to apply for a loan to even begin establishing a score at all. So if you're young, it's expected for you to have a limited credit history. That's okay. So what can you do to get started? At IH, we tend to start off with what's called a share pledge loan. This is essentially a secured personal loan that's approved for anyone who is 18 or older, has taxable income, and $500. So here's how it works. We're going to take $500 of your money and put it in your savings account, and we're going to put it on hold so you can't touch it. Then we're going to fund a personal loan of our money to you for $500 that same day. So you're going to leave with the same amount of money that you came in with. Then you just have a personal loan with us that you pay back monthly. If your loan term is 1 year, then your monthly payments for this would be about $45 a month. And once that personal loan is paid off, the $500 that's on hold in your savings account is going to get released back to you. The interest rate on this loan is 6%, so you only end up paying like $18 in interest back to us at the end of that year. This is going to show a pattern of on-time payments and should establish a credit score for you. After it's completed, you may then be eligible for a small credit card with us. And you may even be eligible to skip the share pledge loan altogether and go right for the credit card with us. Credit cards, they're a great way to start building a credit score if you use them correctly. You would normally have to have a certain score already established to get approved here. However, we understand how hard it is for members with zero credit to get approved for anything. So we've put together some criteria to make things easier in this situation. What we're looking for is that you've been with the same employer for at least 6 months with regular payroll deposits from them to your account here, and direct deposit is preferred. And that you have zero negative account history for the last 6 months, so no overdraft fees basically. And if you don't meet those requirements to start off with a credit card, that is perfectly fine. We can wait until you do meet them, or we can start off with that share pledge loan and do a credit card later. So you may have caught how I said in most cases you have to be 18 to build credit. Well, that's true if you're applying on your own, but there are a couple of alternatives out there to start building if you are under 18. Some financials will allow, say, a 16-year-old to be on a loan with their parent or guardian. We do at IH offer this as an option. However, the approval will solely be based on the parent. They still must qualify. Another option, you can add, say, your child as an authorized user on a credit card that you currently have. This gives them the option to have their own card in their name, use it as they see fit, but they're not obligated to pay that back. You would still be the one obligated to make those payments. But you paying on time will not only help your score, it will establish one for your child as well. Just like regular loans though, if you pay late, it's gonna hurt their score too. And IH does not currently have this option for our members. The last thing I wanted to discuss before moving on is about the buy now, pay later options that are becoming more popular. You may have seen this as an option for you when you're checking out on your grocery order or purchasing something online, where it says split this into 4 payments over 6 weeks. Some companies you may see include Affirm, Afterpay, Klarna. If you choose to do this, you are essentially applying for a buy now, pay later loan. Before signing up, always read the fine print. Some of these companies will complete soft pulls of your credit report, some will do hard inquiries. Most of them don't even report your on-time payments to the credit bureaus, so it won't even help boost your credit score. If you do pay late and it gets sent to collections though, you better believe they will report that to the bureaus. By opting into these buy now, pay later options, you're opening yourself up to possible late fees, interest charges, and in my eyes, it kind of encourages people to buy on impulse and potentially overspend. So I would strongly suggest that when you want to purchase something, plan, budget, and save for it, buy it outright. You might find that you appreciate it even more. Again, if you have any questions about any of these topics, feel free to drop them in the chat. We'll address them later. Finally, let's go over a few tips and tricks so you can improve, boost, and strengthen your credit score no matter where you're at in your life. So as we talked about earlier, take advantage of the 1 free credit pull you get per year and review your report to make sure that all of the items are yours and dispute any discrepancies. Pay your bills on time. Remember, this is 35% of your score. I cannot stress this enough. Pay on time, even if it's just the minimum payment. If you find yourself not able to pay on the due date, a lot of lenders will offer a grace period, maybe 10, 15 days, to where you can pay late without receiving any late fees. And late payments will not affect your credit until you're about 30 days past due in most cases. So it's always a good idea to ask your lender these questions before signing anything. Another big one, keep low balances on all of your credit cards and lines of credit. So general rule of thumb is to always try and keep 70% of your line of credit available to you. So for example, say you have a credit card with a limit of 10,000. Before the billing cycle ends, which is normally at the end of the month, you'll want to make sure that you have $7,000 available to spend on your card. If you have cards that are close to being maxed out, this can actually pull your score down. When I first started to establish credit, the first thing I did was get a small credit card and only use it for gas. When I was done getting gas, I'd get in my car, pull up my IH mobile app, and transfer the funds to my credit card right away. This way, you're showing a monthly on-time payment and you're not even paying interest on the card. So all it's going to do is improve your credit score. You'll also want to keep old accounts open if you can. So say you have 3 credit cards and you're contemplating closing one of them. Say you've had one for 14 years, 6 years, and 2 years. You'll want to close the one that you've had for 2 years. If you close the oldest one, then you're losing 14 years of on-time payment history, which could do some serious damage to your credit score. As previously mentioned, don't apply for too many loans in a short time. Those inquiries or hard pulls, they do stay on your report for 2 years, and too many of them can pull you down. I tell my members to try and stay under 2 hard pulls per year if possible. Avoid impulse buying on major purchases. So if you're looking to buy a car, rate shop. Don't just go with your first option. You could be getting a lower interest rate somewhere else, which we learned earlier will give you a lower payment and save you thousands of dollars on interest. Always, always read the fine print on any loan application. A lot of stores will offer you a discount on your purchase if you opt into their store credit card. They'll say 0% interest for the first year of payments. But what they won't tell you is that after that year's up, it is 25% interest. And don't be afraid to ask questions before getting into any new contract. Also, think twice before you agree to co-sign for someone. Keep in mind that if you co-sign for someone else's loan and they don't make their payments, that will negatively impact your credit as well. I recently just had a member with this scenario. She was applying for a loan and was ultimately turned down because she was a co-signer for her son's car and he hadn't made the payment for the last couple months. So even if you aren't the one actually making the payments every month, it is still your debt. And lenders have to include it when determining your debt to income ratio. So I'm not saying never co-sign, but there are some risks that go along with it that you should definitely think about before doing so. And stay the course. Credit building, it takes time. If you see that your score isn't going up as fast as you want it to, try not to get discouraged. Your score has nothing to do with who you are as a person or how much money you make. This process works. You just have to be willing to be patient and let it work for you. So I am going to pass it back to Katie to address all of your questions in the chat.
Awesome. Thank you so much for sharing your knowledge, Kelsey. I don't think we realize how much really goes into your credit score and credit building. That was a wealth of knowledge. So we did have a couple of questions, and while we're addressing those, if any other questions are lingering out there, please drop them in the chat and we'll address them now. The first one is, what is the timeline that considers credit pulls too frequent? And I think you sort of answered that. You said no more than 2, but is there anything else you wanted to add to that?
I would say that 2 is a good amount of pulls. If you can avoid it at all, like 0 per year, that is ideal, but try and stay 2 or less would give you, okay. It wouldn't damage your score as much. Yep.
Great. Perfect. Another one here. A couple people asked if the financial checkups with financial coaches are free, and I did share that they were,
yes.
Which is an exciting perk. It's something
yes.
definitely take advantage of. But an additional question, what's the youngest age I could add a minor on a credit card as an authorized user?
That will likely depend on what credit card company you go through. I personally have a Capital One credit card, and my son, I added him when he was 9, I believe. So, and it's been, yeah. I'm like, this is what I do for a living. I want to get him, in the right spot when he's of that age too. So
for sure. I didn't realize you could do it that young. I had my son when he turned 18, and then I co-signed for a credit card.
Sure.
So that's great to know that you can do it much younger than that.
Yeah.
Another one here, how can I prepare for a financial coach visit?
That's a great question. I love that. Mm-hmm. I would say it depends on what your overall goal is. So it would be great if, say, your goal is like to consolidate or try and save money, maybe move loans over here, whatever it is, just knowing what you have out there. We're going to do a soft credit pull on you anyways, so we're going to see, but knowing the interest rates, like we can't see what those interest rates are. All we really see is who it is and what the balance is. Right. So knowing what would be best for you, it would be awesome if you could just have that lined up. If your overall goal is maybe saving, just having something laid out, maybe an idea for yourself or what you're currently doing, that would be amazing as well.
Awesome. Wonderful advice. Thank you. Throwing another one out here, where would I go to get my free credit report?
Oh, yes. You would go to annualcreditreport.com. You can pull through each bureau on that website for free. I will say, I don't believe it gives you your score for free, but it will tell you what's on your report. I think you have to pay $1 to be able to see what your actual score is. But if you want actually free, it's just not going to tell you what your physical score is at that time.
Okay. Still valuable. And if you want to pay $1, that's not too bad to get the score too. Awesome. Great. I'm going to take a couple more here. I'm trying to purchase a home. What do I need my credit score at to get a home or to get
Yeah.
pre-approved?
Yeah, absolutely. So I will preface this by saying I'm not a mortgage lender, so I know general information, but as far as doing the loans all day, I don't have that. A lot of times, I would say mid sixes would be a good. I always tell people to shoot for 700. Honestly, if you want the best rates, the lowest rates, the best terms for yourself, you want to be in the 700s. But you can absolutely get a mortgage if you're in the sixes or maybe the high fives. But one thing, if you're looking for a mortgage at IH, like I mentioned, we're going to pull all 3 credit bureaus. But if you're doing it with someone else, we're going to take the lowest score to determine the interest rate. So
Okay.
if you're planning on applying with 2 people, work on both of your credit scores before going in and applying.
That's great. That's great. Okay. Something else too to add to that, we are going to do an in-person mortgage workshop in April. So be watching for that information to come through. And that might be something that you want to attend as well if you want more information about mortgages. So
Yes.
awesome. One more question and then we're going to wrap up. So for your 9-year-old, he is already building his credit now then?
Well, I haven't done a soft pull on him or anything yet, so I'm not 100% positive, but since I did add him, I have activated his card and I've been paying, monthly and everything. So I don't think legally I can pull my son's credit report. I definitely haven't, but that's a great question. And maybe we can go to annualcreditreport.com and see if he has.
Hoping so, right?
Yeah.
That's great. Wonderful. Awesome, Kelsey. This was just some great information. So thankful to everyone who attended, who participated and asked these great questions. If you have other questions about building credit or are interested in a financial checkup that we've been talking about, we have a QR code up on the screen to capture the path to book an appointment with Kelsey. And if you're viewing from your phone, you can copy and paste the short link below the QR code into your web browser or wait until the follow-up email we send out to book an appointment. The steps to book an appointment are here as well. Simply choose the service, financial checkup, and that is the option at the top. You choose the date and time for the appointment that works with your schedule. Fill in your details such as name, email, and phone number, and then share if you're a member or not, and click book. Please keep in mind that meetings, again, with financial coaches for a financial checkup are free, so they're a really awesome perk. Be sure to watch for a follow-up email over the next couple of days with the recording of this session and a survey. We would love to hear your honest feedback about the webinar tonight. Also, please watch for other free webinar opportunities that will be available monthly for sign up. Our next virtual webinar will be March 20th at 6 p.m. on the topic of buying a car. The sign up link to get registered will be in the follow-up email as well. We just want to thank you so much again for joining our February Financial Fitness webinar. We hope everyone has a great night. Thank you.
Thanks, guys.